Stop looking at the Federal Reserve. Stop obsessing over the latest CPI print from Washington. If you want to know if your portfolio is going to survive 2026, you need to look at the single most dangerous number in global finance right now, 160. That is the exchange rate of the Japanese yen against the US dollar. And right now, as we speak, we are hovering terrifyingly close to the edge. It is January 18, 2026. While you've been distracted by domestic politics or the latest tech IPO, the third largest economy in the world is entering a death spiral that could trigger a liquidity crisis worse than 2008. The Bank of Japan, the central bank that has effectively bankrolled global stock markets for 2 decades with free money, is trapped. Here is the nightmare scenario: the yen is collapsing. To save it, Japan has to raise interest rates. If they raise rates, the carry trade, the mechanism that pumps trillions of dollars into US stocks and real estate, blows up. If they don't raise rates, their currency becomes worthless, leading to hyperinflation in Japan and a chaotic sell-off of the $1.1 trillion in US debt that they hold. Either way, liquidity is about to vanish from Wall Street. Today, we are diving deep into the crisis unfolding in Tokyo. We're going to look at why 52 top economists are suddenly rewriting their forecasts, why a new prime minister is terrified of an election next month, and most importantly, why a rate hike in Tokyo means a margin call in New York. This isn't just about Japan. This is about your money. Let's get into it. To understand why the ground is shaking, we have to look at where we stand right now. It is mid-January 2026. The Bank of Japan, led by Governor Kazuo Ueda, is trying to walk the tightest rope in financial history. For years, we joked that the BOJ was asleep at the wheel. While the US Fed and the ECB were aggressively hiking rates to fight inflation back in 2022 and 2023, Japan kept rates at rock bottom. They were the last of standing. But that era is effectively over. The normalization cycle began back in March 2024, but it has been painfully, agonizingly slow. The last time they hiked was just a month ago, on December 19, 2025, bringing the benchmark rate to 0.75%. That might sound like nothing to an American used to 4% or 5% rates, but for Japan, 0.75% is the highest borrowing cost they've seen in 3 decades. The problem? It's not enough. Inflation in Japan has now averaged above their 2% target for 4 consecutive calendar years. The cost of living is crushing the average Japanese household. But Governor Ueda is hesitating. According to a fresh Bloomberg survey of 52 top economists released this morning, the consensus is that the BOJ is going to sit on its hands at the upcoming meeting on January 22. They are paralyzed. Why? Because the Japanese economy is fragile. They are terrified that if they hike too fast, they will crash their domestic housing market and bankrupt their zombie corporations. But the market doesn't care about Ueda's fears. The market smells blood. The X factor right now is the currency. The yen is trading around 158.50 to the dollar as of this Friday morning in Tokyo. That is a disaster zone. We are within striking distance of the psychological breaking point of 160. If the yen crosses 160, it's not just a number. It's a signal that the BOJ has lost control. A weak yen makes imports, energy, food, raw materials explode in price for Japanese consumers. It pushes inflation even higher, creating a feedback loop from hell. The survey shows that 35% of watchers think the current pace is okay. But a staggering 60% of economists say the BOJ is moving too slow. They are behind the curve. And when a central bank falls behind the curve, the market usually punishes them by breaking something. The consensus bet right now? 48% of economists think the next hike won't happen until July 2026. They think they have 6 months to breathe. I'm here to tell you, they are wrong. And if they are wrong, the shockwave will hit your brokerage account before you can say sayonara. Economics does not happen in a vacuum. It happens in the dirty, messy world of politics. And in Japan, the political situation has just thrown a bucket of gasoline on the fire. Enter Sanai Takaichi. She became prime minister in October 2025, winning the leadership contest on a platform that sounded very familiar to anyone who remembers Abenomics. Takaichi is a fiscal hawk's nightmare. She loves stimulus. She loves spending. She has openly backed monetary expansion to juice the economy. Since she took the helm, the yen has been in freefall. Why? Because FX traders aren't stupid. They know that if the prime minister wants to print money to hand out stimulus checks, the supply of yen goes up, and the value of yen goes down. It's supply and demand 101. Here is the twist: Takaichi is planning a snap election for next month. She needs to win big to solidify her power. The rumor mill in Tokyo, backed by recent reporting, suggests she is preparing a massive expansionary fiscal package. We're talking about government spending that will inject billions into the economy. This puts the Bank of Japan in an impossible position. On one hand, you have the prime minister stepping on the gas pedal. On the other hand, you have the central bank trying to tap the brakes. When you press the gas and the brake at the same time, the engine blows up. 3/4 of the economists polled believe this political pressure and the resulting yen weakness will force the BOJ to hike rates earlier than July. They can't wait. If Takaichi wins and announces a massive spending bill, the yen could flash crash to 165 or 170 overnight. Junki Iwahashi, an economist at Sumitomo Mitsui Trust Bank, put it bluntly, that timeline could be brought forward if the yen weakens beyond 160 per dollar. Hiroshi Namioka of TND Asset Management agreed, stating, as long as the yen continues to weaken, the BOJ is likely to continue raising rates. This creates a paradox. To save the currency from the Prime Minister's policies, the central bank has to make money more expensive, which undermines the Prime Minister's policies. It is a civil war between the government and the central bank, and the casualty is the currency. Now, let's bring this home. Why should a software engineer in San Francisco, a real estate investor in London, or a retiree in Florida care about Sanai Takaichi or Kazuo Ueda? Because of the carry trade. I cannot stress this enough, the yen carry trade is the heartbeat of global liquidity. For the last 20 years, interest rates in Japan were zero or negative. This meant you could borrow yen for free. Here is the trade that hedge funds, banks, and even sophisticated retail investors have been running. 1. Borrow $1 billion worth of yen from a Japanese bank at 0% interest. 2. Convert that yen into US dollars. 3. Use those dollars to buy US treasuries yielding 4%, or Nvidia stock, or Bitcoin, or London real estate. 4. Pocket the difference. It was literally free money. It acted as a massive subsidy for global asset prices. It pushed the S&P 500 higher. It kept US mortgage rates artificially lower because all that Japanese cash was buying US debt. But now, look at the math. If the BOJ raises rates to 1.5%, which is the new median projection for the terminal rate, and the yen strengthens, the math stops working. Suddenly, that loan isn't free. And worse, if the yen rises in value against the dollar, you owe more money back than you borrowed. When the carry trade unwinds, it doesn't happen slowly. It happens all at once. It's a rush for the exits. Investors have to sell their US assets to buy back yen to pay off their loans. Selling US assets means stock prices crash. Bond yields spike. We saw a preview of this in August 2024. Do you remember that flash crash? The VIX exploded, and stocks tanked. That was caused by a tiny, incremental move by the BOJ. Now imagine a full-scale normalization cycle in 2026 driven by panic over a collapsing currency. The BOJ is forecasting a 2.7% increase in core consumer prices for this fiscal year. They are predicting sticky inflation. They have to hike. And when they do, the liquidity that has been floating your boat is going to drain away. Takeshi Minami, chief economist at Norinchukin Research Institute, said it best, the BOJ will be required to move away from its traditionally slow pace. It remains essential for the BOJ to maintain a fighting stance. A fighting stance means war on inflation. And in a war on inflation, asset prices usually get caught in the crossfire. Let's go a layer deeper. Let's talk about US debt. Japan is the largest foreign holder of US Treasury bonds. They hold over $1 trillion of our debt. This relationship has allowed the US government to run massive deficits because we always knew Japan would buy our paper. But if the yen collapses to 160 or 170, Japan has to intervene. How do they intervene? They need dollars to buy up their own currency. Where do they get those dollars? By selling their US treasuries. If Japan starts dumping US treasuries onto the open market at the same time the US government is issuing record amounts of new debt, we have a supply glut. Basic economics, high supply plus low demand equals price crash. When bond prices crash, yields soar. If the 10-year Treasury yield spikes to 5.5% or 6% because of a Japanese sell-off, the US housing market freezes instantly. 30-year mortgage rates would hit 8.5% or 9%. Commercial real estate, which is already on life support, would face a wave of defaults that would make 2008 look like a picnic. This is the feedback loop. 1. PM Takaichi spends money. 2. Yen weakens. 3. BOJ forced to hike rates or Japan Ministry of Finance sells US treasuries to intervene. 4. Global liquidity dries up. 5. US yields spike. 6. US economy takes a hit. This is why Wall Street is staring at the calendar for January 22nd and the weeks following. They are looking for clues in the quarterly economic outlook report. This report will incorporate Takaichi's stimulus package for the first time. It is the blueprint for the next 6 months of pain. Economists are predicting small upward revisions to growth 0.9% for this fiscal year. That sounds good, right? Wrong. In this context, higher growth means more inflationary pressure, which means more pressure to hike rates faster. So, what happens next? Let's game out the scenarios based on the data we have. The consensus view, the 48% of economists who say the next hike is in July believe the BOJ can wait. They think the Fed will cut rates, weakening the dollar naturally, which would save the yen without the BOJ having to do anything drastic. Result, markets stay calm. The carry trade unwinds slowly. Stocks trade sideways. The risk case, 17% of economists see a hike in April. This aligns with the start of the new fiscal year. If the spring wage negotiations result in big pay hikes for Japanese workers, inflation will spike, and the BOJ will move. Result, a correction in US tech stocks in Q2 2026. A manageable 10% drop. The nightmare case, this is what I want you to prepare for. The yen hits 160 next week or immediately after the election. The market attacks the currency, smelling weakness. Takaichi's stimulus is seen as reckless. The BOJ is forced to emergency hike or signal a massive hike for March. Result, the black swan. A rapid unwinding of levered positions. We see a liquidity shock similar to the UK gilt crisis of 2022, but on a global scale. Remember, the median projection for the terminal rate is now 1.5%. That is double where we are now. To get there, they need to hike 3 more times in 0.25% increments. If they try to cram those hikes into a short period to save the currency, the shock will be severe. And let's look at the corporate angle. Think about companies like Toyota or Sony. A weak yen is usually good for them because their profits in dollars look huge when converted back to yen. But a collapsing yen destroys their supply chains because they have to import energy and raw materials. Japan imports almost all its energy. If the yen trades at 170, the energy bill bankrupts the small and medium-sized enterprises that supply the big giants. The Japanese economy hollows out from the inside. This is why the weak yen is good for Japan narrative is dead. It was true at 120. It is false at 160. At 160, it becomes a crisis of confidence. We are standing on the precipice of a regime change in global finance. For your entire investing life, Japan has been the anchor of low rates. That anchor is being pulled up. So, how do you protect your money? 1. Watch the US dollar to Japanese yen pair, add this to your watch list immediately. If you see it cross 160, brace for impact. That is the trigger for BOJ intervention and volatility in US markets. 2. Be careful with high duration tech. The stocks that benefit most from low interest rates and high liquidity are speculative tech and growth stocks. These are the assets most vulnerable to a yen carry trade unwind. If Japan hikes, the risk on trade turns risk off very quickly. 3. Monitor US bond yields. If yields start creeping up without any news from the US Federal Reserve, it's likely selling pressure coming from Asia. Higher yields mean lower bond prices and pressure on real estate. 4. Diversification is king. This sounds boring, but in a liquidity crisis, cash is king, and commodities often outperform. If the yen collapses, investors might flee to gold or other hard assets that aren't tied to the whims of central bankers. The BOJ meeting on January 22nd to 23rd is expected to be a hold. They will keep rates at 0.75%. But do not be lulled into a false sense of security. Read the meeting minutes. Look for the dissenting voices. Look at the inflation forecasts. Governor Ueda is running out of time. Prime Minister Takaichi is pushing the country toward an inflationary cliff. The market is betting that something has to break. In 2026, the butterfly that flaps its wings is in Tokyo. And the hurricane is going to land on Wall Street. The era of cheap money wasn't just about the federal. It was a global phenomenon, subsidized by the Bank of Japan. As Japan normalizes, the tide is going out. We are about to find out who has been swimming naked. Keep your eyes on the yen. Keep your eyes on the election next month. The financial stability of the world is currently hinging on the decisions of a few bureaucrats in Tokyo who are stuck between a rock and a hard place. If you found this breakdown valuable, make sure you subscribe and turn on notifications. I will be covering the BOJ meeting live next week and breaking down the Takaichi stimulus package as soon as the numbers drop. Don't let the mainstream media distract you. Follow the money. I'll see you in the next one.